This is Japanese Economic Review Channel. Today, we analyze the historic market shock of June 8, 2026. The Nikkei 225 plummeted by over 2,563 points, fueled by a surge in the volatility index to 41.35. This session was characterized by a massive global liquidity drain and a significant shift in sector rotation. We will examine the macroeconomic catalysts and the anatomy of this historic plunge. The Nikkei 225 closed at 64,024, marking its third consecutive drop. Market breadth was overwhelmingly negative, with 1,073 declining issues on the TSE prime market compared to only 461 advancing. Despite the high trading value of 11.1 trillion yen, the USD JPY remained relatively stable near 160, suggesting this was an equity valuation-driven event rather than a currency shock. This 2,563-point decline is not a routine correction. It represents the fifth largest daily point drop in Nikkei history, and the second most severe shock in 2026, surpassed only by the crash on March 9th. Such a significant move highlights the extreme sensitivity of the Japanese market to shifting global economic indicators. The intraday chart shows a massive opening gap down, inheriting weakness from Friday's US sell-off. Panic peaked at 10:31 a.m., with the index hitting a staggering low of 63,406, a drop of 3,181 points from the previous close. While minor oversold buying occurred toward the end, aggressive entry was limited as investors remained cautious about the upcoming U.S. market reaction. We can trace this Tokyo contagion through a clear domino effect. It began with a U.S. labor report that shattered estimates, leading to a hawkish recalibration of interest rate expectations. As bond prices fell and yields spiked, high multiple tech equities underwent a severe revaluation, which immediately hit the tech-heavy Nikkei at Monday's open. The spark originated from the U.S. May non-farm payrolls, which added 172,000 jobs, far exceeding the 85,000 estimate. This resilience suggested that inflation might remain sticky, forcing the market to delay Fed rate cut expectations. Major tech casualties included Micron and ARM holdings, which set a grim precedent for Japanese semiconductor stocks. We observed a sharp divide between sectors. High-beta industries like semiconductors and electrical equipment, including Advantest and Tokyo Electron, faced a severe sell-off. Conversely, a flight to safety benefited defensive sectors. Insurance giants like MS&AD and food leaders like Kikkoman saw gains as investors sought refuge in value-oriented assets. The squeeze extended to emerging markets, with the TSE Growth Market 250 index falling due to deteriorating investor psychology. While many stocks like PowerX faced critical pressure, a few names like VALUENEX and Terradrone managed to buck the trend. This suggests that even in a liquidity crunch, idiosyncratic growth stories can still attract capital. In conclusion, the June 8th sell-off underscores three key themes. Macro resilience is now dictating micro valuations. Historic volatility is the new baseline for the Nikkei, and active sector rotation is in full swing. While the headline drop was severe, the bidding for defensive stocks and continued corporate innovation, such as new AI features and product launches, remains the foundation for a future recovery. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.